All right, guys, welcome back for another video. I have a lot of different files that I reference often and reference in videos. And I went through some of those files and I picked the one that I thought was the most important out of all of them. And really, I settled on this chart. Before I get into the chart, it is pretty important to know how to select alpha out of a lot of different information. There's a lot of information out there, so having the skill set to be able to sort through that and pick out what's the most important and having the skill set to prioritize different information is one of the most valuable skills you can have in trading. But anyway, let's get back to the chart. So this is basically showing you that it's graphing the total debt to GDP of the U.S. government. Well, the U.S. as a country as a red line, graphed against the inflation adjusted short term rates. So those are real rates, right? When people use the term nominal interest rates, they don't mean inflation adjusted short term rates. When they say real rates, they mean inflation adjusted short term rates. Basically, what that is, taking nominal interest rates, so the yield on treasury maturities, subtracted by the total inflation number. Now, inflation is very difficult to quantify, right? Because you have the CPI, which is the government official metric. Obviously, that's on the lower end of the range, probably actually the very, very lowest end of the range, and there for a reason. So inflation is probably much higher than the CPI. So, if CPI is coming in at 9%, you can probably assume that real inflation is double that, roughly, just for, again, it's very hard to, there's so much uncertainty and noise in the fiat system that there's no solid unit of measurement. So it's very difficult to do that. But just for the sake of argument, say that inflation is at 15%. The way you would calculate inflation adjusted rates is you take your treasury yield. So you take a 2-year treasury yielding 3% roughly, or 3.2%, and you subtract that 3% number by 15%. You've got interest rates uh, running real negative rates at 12%, minus 12%. And what this shows you is it doesn't show you the actual inflation adjusted rates, but it shows you the change from a year ago. So it shows you that as total debt to GDP is rising, represented by the red line, the inflation adjusted short term rates, or the real rates, are declining, uh, you know, are going more deeply negative. And that's because inflation is increasing so fast, right? Inflation is increasing faster than nominal interest rates are rising. So even though interest rates are rising nominally, the rate of change between those two factors is different, in the sense that interest rates aren't rising as fast as inflation. It's increasing the gap between nominal interest rates and inflation. And that's actually causing real rates to go more deeply negative. This is a very important point, right? This is a very important concept to wrap your head around. It'll help you, um, you know, be able to identify the sovereign debt situation with a more accurate filter and not be confused, right? And I know that sounds very condescending, but it's a common thing that, the way people get confused, and central bankers know that that's confusing, and they purposely try to confuse people using those terms. So, as long as you see things in real rates, that'll put things in the proper perspective. So, what you're seeing is exactly what you would expect to see if, government, say you're running a government and your debt to GDP is getting parabolically high. They would have a strong incentive to manipulate the market to increase or to drive real rates or inflation adjusted short term rates more deeply negative. And that's exactly what we see happening. Now, I feel like I need to explain the debt to GDP. GDP is a figure, is in the tens of trillions, and you just divide that by, the amount of nominal debt, right? So it's, really right now, if you were to, this is showing you the rate of change. If you were to go look at the actual debt to GDP ratio, I think it's at 135%. So that, again, that number doesn't mean anything unless you put it in a historical context. To put it in a historical context, um, after 4 years of World War II, and the world was basically brought to its knees, and a lot of countries brought to total annihilation, and really the Earth was at the verge of nuclear war and destruction. Even after that, debt to GDP in America only got to 110%, right? And after where we're at now, after our war on COVID, multi-year war on COVID, we're at 135%. So it kind of puts things in perspective. Um, of course, you can see that on the chart, right? The rate of change for debt to GDP, has been going up very dramatically since the 80s, but then peaked very suddenly during 2020 during COVID, and that's because of all the monetization of the debt and how much new treasuries the government issued at that time. So this, and the reason why this is the most important chart is because this is the real uh, mandate of the Fed, right? People talk about different mandates of the Fed, and they say that the Fed's publicly stated mandate is uh, jobs and stable employment, as well as stable prices. Well, that's their public-facing mandate. Their real mandate, their private mandate, is to keep the government solvent. And in order to do that, with debt to GDP that high, right? The higher debt to GDP goes, the more unstable the finances of the government become, because the more expensive it becomes to finance them, especially as interest rates rise, right? If you rise interest rates into a surging debt to GDP ratio, it becomes incredibly, it's like a snowball effect, because then the new debt issued is put on the balance sheet is being put there at higher interest rates. So then that just means that more debt needs to be issued to cover those interest expenses. So the way out of that is to run real rates negative, right? Which is what we see happening here. So to get out of that, to say again, to go back to that debt to GDP figure of 135%, to get that down below 100% is what you would want if you were managing the government's finances. The only way to do that is to drive real rates deeply negative and hold them there for a period of several years. We've seen them being driven negative, pretty well, really, you know, since debt to GDP has gone up, but they've really gone negative recently since, you know, uh, roughly 2020. So that's exactly what you'd expect if the government's trying to deleverage itself. So I think this is really, you know, the real agenda of the government and the Federal Reserve, despite what they say publicly. And what this means ultimately is that, in order to delever that, to get the debt to GDP down, they have to continue to drive rates negatively and hold them there for a long period of time, which means that inflation will get worse, right? Because remember, these are inflation adjusted short term rates. If inflation is running 12% higher than yields, your real negative rate is 12%. That means that there's a long gap between staying above water, so to speak, in a financial sense, and that causes a lot of different distortions in the market. At certain points, it'll force people further out onto the risk curve. People will, be there'll be a lot more Hail Mary plays, as especially as nominal interest rates rise in line with inflation, and people are incentivized to take riskier and riskier bets to stay afloat. And of course, that adds risk to the system as well. So, and that you know, it's just it's a negative feedback loop that kind of compounds on itself. Um, and ultimately, I think the moral of the story is that this is not like a one-off transitory thing. This is like a trend that probably is going to define the next few years and probably the rest of the decade, really. So, I think A solid investment thesis is identifying what type of assets would perform well in that type of environment. Some people call this stagflation, but I think that's kind of a surface level way to identify it. But even then, I think it's pretty spot on. I don't really want bonds and equities in that environment. There's a solid case to be made for commodities or anything that has is priced in energy and can't be stolen and isn't a paper derivative. But anyway, not financial advice. Do your own research. Again, if you guys like this content, just subscribe to the channel, leave a like on the video, and I'll catch you guys in the next upload.